Uh, there we go. Good morning or good afternoon, depending on where you are. We are happy to continue with the second of our CEPR International Trade and Regional Economics new member series. We are getting to see the presentations and the research of our young colleagues. So without further ado, I will turn to Adrien and just remind everyone that we will go 50 minutes, preferably with just short clarification questions. You can jump in and ask him or type and I can intermediate, and then we'll have a 10-minute discussion at the end. Go ahead, Adrien.
All right, can everyone see the slides? Perfect. Well, so first, thank you very much for inviting me and inviting me to the program. It's a real honor to be part of this community of scholars. So today it's an international and regional economics group. Today last time we saw more about international economics, and today we're going to talk more about regional economics with the geography of unemployment. So the starting point of this paper is that cities differ dramatically in their unemployment rates. For instance, in 2017, the unemployment rate was about 5% in Versailles, which is an affluent city close to Paris in France. In the same year, in the southern city of Marseille, the unemployment rate was well over 12%. Now, these gaps, they're not special to 2017. In fact, they've been highly persistent over time, and they're also not special to France. Similar gaps have been documented in many other countries, Germany, the UK, and the US. And you can think of the US, you can think of Flint, Michigan versus Boston, Massachusetts, for instance. Now, this dispersion in local unemployment rates is somewhat puzzling because in principle, both workers and firms could relocate across space. And these unemployment gaps could have large welfare consequences. We know from a large body of work that being exposed to unemployment is harmful even in a strong labor market, but spending a lifetime in a distressed labor market like Marseille in France or Flint, Michigan in the US could have dire long-run effects on workers. And policymakers seem concerned about these spatial unemployment gaps because we see local governments spending billions of dollars every year to attract jobs. At the same time, we know relatively little about the determinants of these spatial unemployment differences. And so in this paper, I tackled three questions. First, why do we see these persistent unemployment gaps across space? Second, what are the welfare implications of this dispersion for workers? And third, then, in general equilibrium, what can we say about place-based policies that explicitly target high unemployment areas? And I propose answers to these questions in this paper in 4 parts. In the first part of the paper, I document that the unemployment rate is high in Marseille in France or Flint, Michigan in the US, not because workers struggle to find jobs there. The unemployment rate is high because workers repeatedly lose their jobs in these cities. Quantitatively, differences in the rate of job loss account for 3/4 of the cross-sectional dispersion in local unemployment rates. I then zoom in onto the job losing rate in France using matched employer-employee data to then show that the job losing rate is elevated in some cities primarily because employers are systematically different in those cities. That accounts for about 2/3 of the cross-sectional variation, while worker composition accounts for a little under 1/3. And so together, these observations imply that there are systematic differences in the type of jobs across locations rather than differences simply in the number of jobs. And so in the second part of the paper, I propose a view of spatial unemployment differences that emphasizes this key role of employer heterogeneity. It's going to be a theory where different employers have different types of jobs. Some are really productive and turn out to be very stable. Others are less productive and turn out to be less stable. Employers look at the world and they decide where to open shop, in which location. That's going to lead to sorting and therefore endogenous differences in the rate of job loss. Now, a clear implication of this framework, which will become clear once we see the actual details, is that labor market frictions distort the location decision of these employers. And in particular, too many of the highly productive employers with stable jobs locate in top locations like Versailles, which leaves only employers that are not productive enough with jobs that are too unstable and distressed labor market like Marseille. And the immediate policy implication is that place-based policies that relocate more productive employers to high unemployment labor markets can raise welfare in the aggregate. So that provides a qualitative justification for enterprise zone programs, for instance. Now that's all qualitative at this point. To then go quantitative, I structurally estimate the MOL in the third part of the paper using the French admin data. The MOL accounts for about 80% of the cross-sectional differences in local unemployment rates, as well as for the key role of job loss in driving that variation. The estimated MOL also indicates that if employers made socially efficient location decisions, unemployment gaps would close by 85%. So that's a large reduction. That indicates first that the location decision of these employers is key in understanding spatial unemployment gaps, and also indicates that there's possibly scope for policy intervention. So the fourth part of the paper, I then evaluate the impact of place-based policies in my estimated GE model. And I find that corporate tax credits that are more generous in cities with high rates of job loss raise welfare in the aggregate by relocating these more productive employers with stable jobs where the planner wants them to be. The optimal policy raises welfare by aggregate welfare by 1%, and these gains contain 10% in the most initially distressed locations. And I then compare those gains with those from a real-world enterprise program in France. Okay, so the plan for the talk today is largely going to follow these 4 parts. Let me just very briefly put the paper into context. There's a long tradition in macro that studies the role of inflows, job loss, and outflows, job finding over the business cycle for the aggregate unemployment rate, and has broadly concluded that its differences over time in the job finding rate that are the key driver of unemployment fluctuations. Now, perhaps for that reason, most, if not all, models of spatial unemployment, have relied exclusively on variation coming from the job finding rate and driving unemployment gaps across cities. Now, in this paper, I show that, in fact, in the data, it's the job losing rate that's the key driver of spatial unemployment differences. And so we're going to need a slightly different theory to think about the data and to think about policy. Okay, so let me start with the first part of the paper, the empirical evidence. So from my main analysis, I'm going to use matched employer-employee data from France. It has 2 key advantages for the question we're interested in. The first one is that I can see, a large cross-section of workers, about 1 million individuals in every year. So that lets me disaggregate the data by location or other fine-grained characteristics. It also tracks workers throughout their employment history. And so I can, see workers in many years, which lets me control finally for worker composition. In that data, I'm going to define a city or location. I'm going to use these words interchangeably, or local labor market, as a commuting zone, which is an area where most people who live in there also work in there. And that's defined by the French Statistical Institute. That's for France. For the US, I'm going to try to construct a sample that's as comparable as possible. I'm going to use the current population survey. Okay, so consistent with a lot of previous work, I do find that there are large and persistent unemployment gaps across cities in this data. And instead of dwelling on those, let me jump right into the main empirical exercise in this paper, which is to unpack whether a high unemployment rate in the city is there because there's a lot of job loss or workers can't find jobs very often. So to run that exercise, it's useful to start with a very simple accounting model for local unemployment as a super stylist. So we're going to think of a bunch of cities C, not even migration between cities and constant labor force participation in every city. Then the super stylized environment, the change in the unemployment rate between 2 time periods here is equal to the difference between inflows and outflows. Inflows into unemployment is the job losing rate, S, like separations into unemployment, that's city specific, times the fraction of employed workers in that city, 1 minus the unemployment rate. The outflow from unemployment is the job finding rate times the number of locally unemployed workers, the unemployment rate. In steady state, you can rearrange this equation to arrive at a very simple relationship down here that expresses the local unemployment rate, or this kind of transformation thereof, the log of the unemployment to employment ratio, to the log of the job losing rate net of the log of the job finding rate. And this relationship has been used a lot in the business cycle literature to unpack the role of inflows and outflows. I'm going to do a similar exercise here, but instead of doing it over the cycle, I'm going to do it across cities. So I'm going to essentially plot each of those 2 components on the right-hand side against the left-hand side, and that's going to tell us, which one is driving most of the variation. I'm going to do that for France and for the United States. And then I'm going to zoom into the job losing rate and break it down into a piece that comes from worker composition and a piece that comes from employer composition. And that I'll be able to do only for France. Okay, so let's look at the data. On the y-axis here, we have the log of the job losing rate, the mean. On the x-axis, we have this transformation of the local unemployment rate on the x-axis. Okay, every blue bubble is a French city, and every green dot is a bunch of metro areas in the US, because the CPS in the data has a smaller cross-sectional size, and so to reduce measurement area, you have to bin these cities together. Now, regardless of the country you're looking at, and the thing that jumps at you when you look at this figure is that, well, it's lining up along the 45-degree line quite closely. So that's telling us that differences in the rate at which workers are losing their jobs across place, is the primary driver of unemployment differences across cities. You can do a similar exercise with the job finding rate instead. That's the right panel here. And you see that it's comparatively flat across cities. Not completely flat, but it's comparatively flat. Quantitatively, the job losing rate accounts for about 3/4 of the spatial variation in unemployment rates, both in France and in the United States. So the obvious question, and that also holds within industry. So industry is not a big part of this story. And so the natural next question is whether these big differences in the rate of job loss are coming from differences in the type of workers who reside in some cities, or they're coming from differences in the type of firms or employers that operate in those cities. And so to answer that question, I'm going to leverage the matched employer-employee data in France. What I'm going to do is project job loss indicators. So EU, this is an indicator at the worker quarter level on a set of worker fixed effects and a set of employer fixed effects. So this is like an AKM regression, but for job loss. And then once I've estimated this two-way fixed effect regression, I'm going to retrieve the estimated fixed effect and average them within every city. So I'm going to have an average worker effect in any given city and an average employer effect in every given city. And that's going to tell me exactly what fraction of the variation in job losing rates across space is coming from worker composition, that's the blue area in this figure, versus employer composition, that's the orange area in this figure. And for this exercise, I call it employer establishment by occupation, but you can do it different ways, firms by occupation, it doesn't change the picture. So what do you see here? Well, you see that worker composition, sorry, I should have said, on the x-axis, we have the unconditional job losing rate in a given city, standardized between 0 and 1, and then I'm simply asking what fraction of that unconditional job losing rate is coming from the blue guys, the worker fixed effects versus the employer fixed effects. And so, employer composition does matter, to some extent in driving those differences in job losing rates. It drives 1/3 of the cross-sectional variation, but the overwhelming majority, 2/3 of the variation is in fact coming from systematic differences in the type of employers who operate across these cities. And so if we take stock from what I've shown you so far, showing that there are large differences in unemployment rates across cities that are coming from systematic differences in how fast workers lose their jobs across space. And when you look at job loss across cities, it turns out that it's coming from systematic differences in the type of employers who operate across these cities in France, at the very least. And so that then leads me to the second part of this paper, which is to write down a theory of spatial unemployment differences that precisely emphasizes this key role of employer heterogeneity. Okay, so let me just give you a broad overview of the main ingredients of this model. So it's going to have many cities, and there's a frictional labor market in every city, so that workers lose their jobs sometimes, they found their jobs, and they spend some time unemployed. So that's going to look a lot like the Klein and Moretti economy. So this is the standard part of the model. And to that, I'm going to add a key building block, which is a location decision for heterogeneous employers. So some employers will be high productivity, offer high productivity jobs. Other employers will be less productive and offer low productivity jobs. Think about a high productivity job as a meat specialist position at the high-end restaurant. The low productivity job is going to be a burger flipping position at the McDonald's. Now, all jobs are subject to some sort of fluctuations. Sometimes workers fight with their managers, and so they get fired. But jobs at more productive employers will turn out to be more stable. They're going to last long. And then employers are going to look at the world. They're going to say, well, I want to open shop in Marseille. Some other employers will want to open shop in Versailles. And so that sorting, which I'll discuss extensively in a couple slides, will lead to endogenous job losing rate differences across places. I'm going to show you the model in a simple version first, so that I can make the mechanisms clear. And then before I'll take you to the data, I'm going to add a number of bells and whistles just to make it more amenable to quantitative exercise. Okay, so here's this, kind of the more formal setup. Time and space are both continuous. There's a continuum of city sites where every city site is indexed by its local TFP, which I'm going to denote by curly L, like location that has some exogenous CDF for now. That's all exogenous for now. Later on, I'm going to endogenize this with the human capital of the local resident. So that's just kind of some fundamental differences across cities that will let me focus on the location decision of employers. There's a fixed supply of land that leads to land rents that workers have to pay to absentee landlords. Okay, that's also going to be a little bit more, a little bit richer in the quantitative model. Workers are all the same for now, and they live forever. They like to consume a freely traded final good as well as housing, according to a Cobb-Douglas aggregator. They have some discount rate for the future. These workers can be either unemployed or employed, And for now, they're freely mobile across cities. Local labor markets are also fairly standard. There's a single labor market in every city. And workers, unemployed workers, search for jobs, and they can search only where they live. Okay, so that's why the relevant notion of a local labor market or location here is a commuting zone. Unemployed workers randomly meet vacancies in their own local labor market according to a Cobb-Douglas matching function. And when they meet with an employer, these workers Nash bargain over wages with a bargaining power beta. Okay, so that's all very standard. This looks a lot like the Kleiner-Reddy economy so far. The new part is this location decision for our heterogeneous employers, and it's going to be structured in 3 steps. In the first step, employers, pay an entry cost just to learn how good they are and to operate. So if they pay the entry cost, they learn some signal about their expected productivity that I'm going to call quality and denote by C. Okay, so quality really governs your expected productivity once you start production down the road. Once you know your quality Z, you're going to choose where to open shop, and then you're going to post a vacancy in the local labor market. After a while, your vacancy is going to match with the worker, at which point you're going to draw some match-specific productivity Y0 from a distribution that it depends on your quality. So it's a conditional distribution, and that's why quality matters for expected productivity. Just to make the exposition as simple as possible, I'm going to take this conditional distribution as Pareto, where the tail index is inversely related to quality. So what does it mean? It means that high quality employers draw from a right skewed distribution, and so they're more productive on average. Okay, so Z controls the mean. Now, if they decide to produce together, the employer and the worker are going to produce YT times L, where there's some complementarity in the production functions here. And so that's why this local TFP term ranks locations from the perspective of employers. So the productive unit here is the match. So you can think of these employers in many ways. You can think about them as firms that operate a single worker, so small firms, or you can think about them as large constant returns to scale firms that are operating many matches at the same time, and perhaps they're sending some workers to Versailles and they're sending some workers to Marseille. Okay, over time then, once you've drawn your Y0, the idiosyncratic productivity of the match fluctuates over time. It follows a geometric Brownian motion so that it's like a random walk with drift in continuous time. So there's a negative drift and there's a volatility. Now, this process is important because it's persistent. So it ties together the productivity of a match at a given point in time and the risk of job loss. And so more productive matches are less likely to break up. But of course, because of the negative drift, all the matches will eventually break up. And so we'll get endogenous separations in all locations. But importantly, this process is the same across places. And so differences in the rate of job loss across cities will have to come from something else than the productivity process itself. Okay, so if we look at this location decision problem, we can solve it by backward induction. You start by looking at what an employer does conditional on entering in location and having a worker. Then it's solving an optimal stopping problem. It's simply deciding when to keep the worker and keep on producing, or when to let the worker go, presumably when the idiosyncratic productivity is going to become low enough. Okay, so that's the first part. And then once we understand what's going on inside the labor market, we can take a step back to think about the location decision of these employers. Now, fortunately, you can solve this stopping problem within every location in closed form, even though these firms are looking forward in time and anticipating future productivity fluctuations. Now, this closed form solution gives you 2 things. It gives you first, the value of operating in the location L, given that your match-specific productivity is Y. So that's going to be useful to compute the expected value of entry in a given location when we go back to step 2 and think about the location decision. The other thing it gives you is the separation threshold, I'm going to call Y bar, at which matches break up. So when productivity crosses that threshold Y bar, the match breaks up and the worker transitions back into an employment. That's going to be useful to think about what determines the job losing rate in every location. Okay, but first thing first, let's think about the location decision of these employers. So you take this value J, integrate against the Pareto distribution, and then you arrive at the expected value of entry of an employer with quality Z that contemplates entering in location L. Oh, sorry, I just realized there's a question in the chat. I hadn't seen it. Do you mind if because it's on the empirical part and minimal of the model part, do you mind asking it again at the end? And I'll very happily answer that. Thanks. Okay, please, feel free to interrupt to ask questions. I'll happily take questions along the way. Okay, so that's the expected value of entry if your productivity or quality Z as an employee, you're thinking of opening shop in all possible location L. The first term in blue is a kind of a fairly standard term. It's telling you that high quality employers value relatively more cities with high TFP. So, because of the complementarity in the production function, if you're a high type firm, you like a good locations for production. That's very standard. It's present in many assignment models in the literature. The second component is a little bit more interesting because it's specific to the presence of labor market friction. If I'm a high quality employer, this component tells us that I like relatively more places where it's easy to recruit workers. How easy it is to recruit workers is embedded in the vacancy contact rate Q, which in turn depends on the local tightness of the labor market. Why does this term show up? Well, if I'm a high quality employer, I generate higher profits in general. And so for me, waiting a given amount of time until I start production is relatively more costly because I'm foregoing these higher profits. Okay, and in equilibrium, how fast I can start production depends on the tightness, which is the ratio between the pool of vacancies relative to the pool of local unemployed workers. So I'm going to, that really captures what Marshall had in mind, back in the 19th century when he was thinking about labor market pooling externality. So I'm going to follow, his terminology here and call that labor market pooling complementary. Okay, the last piece that matters is, of course, the expected cost of labor conditional on starting production, and that can be summarized by the local reservation wage, which is proportional to the separation threshold. Now, it's important to keep in mind here that when these firms are thinking about local productivity versus vacancy contact rates Q, of course, both matter. And so it's not that the high productivity firms are all going to go to only where vacancy contact rates are high. Of course, that force matters only conditional on local productivity. Okay, so the equilibrium correlations between local productivity, local unemployment, can be complex and small. But what is clear is that both forces push firms to sort across cities. Okay, so you can make these arguments a little bit more formal, conditional on some technical conditions. There exists a unique steady state. In the steady state, there is positive assorted matching between firms and locations. And so high quality employers, those with the high Z, they go to locations that are higher ranked in terms of their local TFP. That's the L, the local TFP of the place. How does this assignment, how is it sustained in equilibrium while reservation wages are rising to the background? So you have high TFP places with high productivity employers and high wages in these places. That's Versailles. And then you have places like Marseille, low productivity, low quality firms and low wages. And so, okay, so then firms based on these wage differences decide where to go. Now, to understand the role of the pooling complementarity in driving this assignment, here I've only made a case in terms of exogenous primitives, but you can ask, okay, what does the pooling complementarity do to the economy? You can take a very special limit of this economy, the one where the local TFP differences across cities disappear. So then all locations are the same ex ante. However, there's still going to be this, they're going to be different exposed once the equilibrium is realized. There's going to be differences in the quality of employers and differences in wages across places. And that's precisely because of the pooling complementarity. There's a coordination equilibrium where, all the good firms go to one place. That creates favorable hiring conditions for the workers, that brings in more workers, house prices rises, and that sustains the equilibrium and nominal wages are high in these locations. Now that's in the very special world in which there are no differences across locations ex ante. Exposed though, yes, I'll take the question in a second. Exposed, once the equilibrium is realized, locations are different. But once you have some differences in local productivity across places, the pooling complementarity is simply going to amplify these local productivity differences and going to stretch the assignment of firms, leading to big differences in quality of employers across cities. Yes, Alessandro.
Hi, Adrien. So super cool. I just have a doubt that is kind of rumbling in my head. And I don't know if I've missed it at the beginning, like you said, something that I've missed it, or if it is something that you can clarify me. So from your motivation, it was not 100% clear to me that you want to model the location decision of the firm. So I didn't see, like, I would have expected you to tell me, firms selectively choose the location more than workers moving around in France. I don't know, the mobility costs in France are so high for workers that they actually don't move. And so I was having in mind, I find, your idea of modeling this very, very cool, but how your model would differ from a model in which you exogenously set the location choice of firms, and then you allow workers to selectively decide where to work with assortative matching, with pooling complementarity, with all these kind of mechanism that you have in mind at play?
Well, so the pooling complementarity is for the firm, so it's not gonna affect the worker.
Sure.
So you could I'm giving you a theory of why we're seeing productivity differences across locations. That's because the firms sort. Now you could say I'm going to take the sorting, the equilibrium sorting, and say actually I'm going to make that exogenous. I'm not going to think about where it's coming from, and then you would get similar predictions, of course, because conditional on the sorting of these firms, then all the rest of the model is going to follow. So you get similar predictions. Now in practice, firms do decide where to open shop, particularly the big firms, the big retail firms. They're really deciding where to open their different establishments. Even for smaller businesses, they're thinking what's the most favorable place to open shop. So I think it's first realistic to think about the location decision of firms. It's going to lead to interesting policy implication. That's another interesting part. The third part, though, I think is more about the economics. Is well, I cannot always assume some crazy productivity distribution and rationalize what I'm seeing in the data. The question is, in practice, there are good reasons to think that these firms move. In fact, they move at relatively, if you look at mobility rates of establishments, it's not unlike the mobility rate of workers. So if you have mobility on one side, why not have it on the other side? And so the question is then, what are the economics that sustain a certain distribution of productivity across places that then leads you to see these big differences in unemployment rates? And so that's precisely what the sorting model is doing.
Okay, thanks. So you observe mobility of establishment in it.
Yes, you can do that.
Information that I wanted to. Okay, perfect.
I mean, it's not as clean in terms of measurement because what is really going on? It's not so, which is why I'm not putting it in the intro. But you do see mobility of establishments.
Okay, thanks.
Cool.
Thanks.
In any case, even if there's no mobility of establishments, the firm is still choosing where to open shop in the first place. So yeah. Okay.
I kind of believe that. So cool.
Super. All right. So so this part, like the sorting model, gives you differences in firm quality across cities. And then the question, which is very related to what Alessandro was just asking, is how do these differences in quality, conditional differences in quality that are coming from the sorting part, translate into differences in unemployment rates? And in particular, into differences in job losing rates. So the job losing rate in this environment depends on three things. The first one is the starting productivity of new matches, which depends on the quality of firms that open shop in the location. Then the job losing rate depends on when those matches break up. That's the separation threshold that's coming from the stopping problem. And then it depends, of course, on how fast productivity depreciates from the starting point to the end point. That's on average the negative drift. So you can characterize that again in closed form in this environment. And you'll find that you can express the job losing rate in location L as a very simple function of the drift and the equilibrium quality of the firms in that location. And so, the higher the negative drift, the more negative the drift is, of course, the faster jobs depreciate in all locations. So that increases the job losing rate on average across places. But importantly, the higher the quality or the productivity of employers in a given location, the higher the Z, the lower the job losing rate. Okay? That's simply because the gap between the threshold and the starting point is then bigger. And because we know that firms sort across cities, the Z is monotonic, it's going to be very low in some places, very high in others. We should expect big differences in job losing rates across cities. The job finding rate has two forces that tend to offset each other. And so I'm not going to have time to go into the details here, but it's going to be relatively flat across places. And the last piece is, of course, the unemployment rate, which is the usual formula relating the job losing rate and the job finding rate. Okay, so that's how you go from the sorting to the positive implications, big differences in job losing rates, relatively smaller differences in job finding rates, and the resulting unemployment rate across place. Okay, so that's it for the positive implications of the theory. Now, before I go into the normative implications of the theory, let me first show you some basic moments in the data that align well with the core structure of the model. Okay, so at the heart of the model, there's this negative relationship between productivity and job losing rates at the firm level and at the city level. So at the firm level, you see a very, very steep declining relationship between labor productivity here on the x-axis and the job loss probability. That's been documented, in some ways and some other places. I'm just showing it here again, just to convince you that this very strong link between the current firm productivity and the job losing rate is really a stylized feature of the data. And calls for a persistent productivity process. If you have IID shocks, there's no way you can get this relationship in the data. Okay, So that was across firms. Do you see the same relationship across cities? Well, the answer is yes. Within a city, you can plot the entire cumulative distribution of labor productivity on the x-axis, on the y, and then just the CDF on the y-axis. Sorry, I should have said that this is all coming from balance sheet data for the universe of firms in France. And you can see that the distribution of labor productivity in blue, which is cities with low job losing rates, first order stochastically dominates the distribution of labor productivity in orange, or cities like Marseille with high job losing rates, okay? And so there's a difference in means. These are the vertical bars here. So again, what we're seeing in the data seems to align very well with the structure of the model. Turns out you also see kind of a stronger productivity gap for young establishments, which is consistent with some more subtle predictions of the theory. I'm not going to have a lot of time to go into that. And then there's the question of, well, what does market tightness do across locations? So I used some data on vacancies at the establishment level, and the measurement matters a whole lot. So it's not as clear how to map the data, the model to the data, because job to job mobility starts to matter a lot. So you have to correct for that. And then the theory doesn't have very clear predictions anyway, because once you have productivity differences, you don't know which way vacancies should go. And so depending on how you correct for job to job search, you can get that, high unemployment cities have more or less vacancies per unemployed worker. And so that's kind of a little bit of an open question in terms of measurement. But in any case, we're going to see that the model is going to match that exactly once we go to job losing rate versus job finding rates. But if you're interested in the details, you can take a look in the paper. Okay, so that was it for the positive side of the theory. Now, what about the normative implications? Okay, so this is a random search model. And so, there's an overall entry externality and there's an overall separation externality, just like in the standard DMP model. And you can shut down those externalities if you enforce the Hodge's condition, which is that the bargaining power is equal to the matching function elasticity. Okay, so that's super standard. It's been studied in Klein already. Now here, there's an additional source of externalities, which is coming from this location decision of these heterogeneous employers. And it's tightly linked to the labor market pooling complementarity. And so I'm going to call this externality labor market pooling externality. And it's kind of what Marshall had in mind back in the days. So to understand the nature of this externality, let's think about the medium productivity firm, say a mom and pop restaurant that's thinking about entering in Versailles, where you only have the high-end restaurants, or going to Marseille, where you only have McDonald's. If the mom and pop restaurant goes to Versailles, it's going to be less productive than the incumbent high-end restaurants there. However, it gets pooled in the same labor market, in the same matching function as the more productive incumbents. And so it's going to get as many job applications as the more productive incumbents. That's not good from the planner's perspective. The planner would like to send more applications to the more productive incumbents. Can do that because it's, but in the decentralized equilibrium, that doesn't happen because it's random matching. And so at the end of the day, it means that the mom and pop restaurant who goes to Versailles is essentially free riding the favorable local labor market conditions that have been precisely created by the more productive incumbents. So if you're familiar with Duran Acemoglu's Good Jobs versus Bad Jobs paper in the early 2000s, it's exactly this externality that's going on here. It's a composition externality, but in the spatial context instead. Okay, now I should have said that every firm has an incentive to free ride the next best labor market. And so in equilibrium, everyone tries to move up a little bit too much the ladder of cities. So you get excess concentration of the good jobs in the top labor markets, leaving only employers that are not productive enough with jobs that are too unstable in the low and lower labor markets. So you can make this formal once more. You can show that the decentralized equilibrium is always inefficient, regardless of whether the Hodge's condition holds or not. And that's precisely because of this labor market pooling externality. Can you restore efficiency with simple instruments? And the answer is yes. You need a set of place-based policies. Now, because the strength of the externality differs across locations, and you have to essentially, it has to be because you have to relocate the more productive guys to the low productivity locations. So you can do it in different ways. The easiest way from the perspective of the model is a place-based profit subsidy or corporate tax credit relative to a base rate if you have one. And this tax credit has to be more generous in cities that have high rates of job loss and so high unemployment. Okay, so the job losing rate is some sort of sufficient statistic for this policy. So that gives you, at least qualitatively, a justification for many of the actual place-based policies we see in practice, like enterprise and programs that are precisely giving these firms, big corporate tax credits when they're, opening shop in particular locations. Okay. So that's it. That's it for the normative implications of the theory. And then the question is, quantitatively, how big are these externalities and how big are the policies that should push back against them? Okay. So I'm going to take them all to the data. To do that, I have to add a number of extensions just so that we can match kind of important statistics at the local level and bring in some more forces that are going to push back or amplify these externalities. So the first thing I'm going to add is dispersion not only in local productivity, which is now denoted by P, but also in amenities A, so that we can match both population and wages across locations. Housing is going to respond elastically to supply. Think about land developers in the background, and there's some supply elasticity data. Housing also affects production, so firms use land and production, and so that's going to imply that congestion effects from relocating people, workers across cities, is also going to affect the returns to job creation for firms directly. Workers are not imperfectly mobile. They're facing some, the usual extreme value shocks that they draw every once in a while. So they move across places imperfectly, and that leads to an effective migration elasticity 1/epsilon. Okay, then two key additions to the model. The first one is worker heterogeneity. I'm going to have workers differ in their human capital here at birth, but also it's going to differ ex post. As workers go through employment spells, they learn on the job and they accumulate human capital. If they're unemployed, they lose that human capital over time. So that leads to scarring effects of unemployment, and that's going to be a big amplification force for the welfare gains of place-based policies. If you lower the unemployment rate in place, that's going to be good for workers directly. They're employed more of the time, but they also are able to escape these poverty traps and accumulate human capital in the long run more frequently. Okay, that's one. The last extension is having a convex vacancy cost. And so now firms can post many vacancies if they like, but that comes at a convex cost, and what kind of training cost, if you like. And that's important because it's going to give a chance to the high-end restaurant in Versailles to differentiate itself from the mom-and-pop restaurant by posting more vacancies. And so that's going to offset partly the strength of the pooling externality. Okay, so that's a lot of extensions. It turns out that if you put them in the right way, all of the previous theoretical results are going to extend, except that employers are going to sort along not just productivity, but a composite index of local productivity and amenities that I'm now going to denote by a curly L. Here, the index is increasing in productivity and decreasing in amenities because of the housing price trend. And employers also value local human capital differences that are endogenous, that are coming through the scarring effects. And so local human capital is lower when the unemployment rate is high because workers are scarred more frequently, and employers internalize that, and so they prefer places where human capital is higher. Okay. Now, having kind of sharp results here is useful, not just to have sharp results, but mostly for estimation. Because it turns out that if you have about 15 parameters here. If you pick them in the right order, you can just run a sequence of regressions to estimate all of those parameters without ever having to simulate from them all. So that makes it very efficient, and you can see exactly where the identification is coming from. So I'm not going to have time to go into the details today. It's in the paper if you're interested. Okay. Instead, I'm going to jump right into the results that are coming from this the quantitative model. Okay, so this is, if there's one graph I want you to take out of the paper, it would probably be this one. So here I'm giving you again the graphs that compare the job losing rate on the unemployment rate panel A, job finding rate, the unemployment rate panel B. You have the data, kind of the blue bubbles in these thin lines, and I've overlaid the prediction of the model, the thick blue line. Okay, so the model matches quite well the broad patterns between the job losing rate and the unemployment rate, and also matches well the relatively flat job finding rate that you see in the data. Now, of course, you could say, well, but if you've targeted it, why you're proud of it? Turns out that these moments are not targeted. I'm leaving completely free the location decision of employers. And so going back to your earlier question, Alessandro, it's really a test of the model, whether in the model employers are sorting in ways that lines up with the data so that you can generate patterns of job losing rates and job finding rates that are empirically plausible. Okay, so I haven't shown you the estimations, or for the purposes of today's talk, you're going to have to take my word for it. But I'm going to show you one exercise in the next slide that hopefully will convince you a bit more that these moments are not targeted. Here, I'm just going to show you some kind of aggregate statistics in the model and in the data. The first column is the data, and the second column is the model, to show you the quantitative performance of the model. So The aggregate unemployment rate is spot on, but that one is targeted. So no reason to be proud there. The model generates about 80% of the cross-sectional dispersion in local unemployment rates. So that was the number I gave you in the introduction. So it's getting most of it, not all of it. And that's partly related to the role of worker composition. And we can talk more about that at the end. What's interesting is that the model also gets the split between job losing rates and job finding rates quite close to what it is in the data. So now to convince you that this is not mechanical, let me show you a different model, or almost identical model that is re-estimated on the same data. This is the planner's allocation that I estimate on the same data. So it coincides with a completely directed search model. So that's a model where you're shutting down the pooling externality, and then you're asking, well, let me estimate it on the same data. What does it predict? And here you see that it's predicting much, a lot less dispersion in local unemployment rates. It's 15% of its baseline value, and the split between job finding rates and job losing rates doesn't line up with the data. So what is going on here? Well, you're shutting down the labor market pooling externality. So that gives one reason less to these employers to sort. And because we have a micro-funded theory of location decisions, that then messes up the overall productivity distribution across locations relative to the data. So this is where assuming it, as you were suggesting, versus modeling makes a big difference, because it lets you tease out different mechanisms. And so employers don't sort as much in the planner's allocation. And so there's much less dispersion in local unemployment rates. Okay, so this pooling externality is really important in magnifying spatial unemployment rates by a factor 5 to 6. And so it's telling us, well, first that these moments are not targeted and it's a meaningful test of them all. That's okay. That's the less interesting part. The more interesting part, it tells us that the location decision of these employers is actually pretty important when you want to think about spatial unemployment gaps. And the third thing it tells you is that there's possibly scope for policy implication, because the constraint efficient allocation differs so much from the decentralized equilibrium, at least in terms of allocations. So that's the fourth part of the paper, which is going to evaluate the impact of place-based policies in this estimated GE model. And we're going to consider two types of policies. The first one is the optimal, or let's call it the quasi-optimal policy that corrects the labor market pooling externality. Now, consistent with the theory, it takes the form of a profit subsidy or corporate tax credit that is more generous in cities with high rates of job loss. To make the funding side non-distortionary, it's going to be federally funded with a flat earnings tax. You have to keep in mind that this is just some benchmark. It's a really big redistribution that it implies 2% of GDP. So, probably not very realistic, but let's just use it as a benchmark. It's called quasi-optimal because I'm not going to correct the Hosius condition that's been studied elsewhere. So I'm just going to focus on correcting the labor market pooling externality. Okay, so that's for the optimum policy. Then there's I'm going to contrast that with an example of an enterprise-owned program, the Zone Franche Urbaine, which is a program that was rolled out in '96 in France and then expanded, that targets high unemployment areas with large corporate tax breaks. So qualitatively, it looks a lot like the optimal policy or the quasi-optimal policy. It's much smaller in scale and scope. It targets just kind of a subset of locations. It redistributes 0.04% of GDP. And so I'm going to consider a budget equivalent version of that policy inside my model. Okay, so let's look at the allocative implications of this policy, and then we'll conclude with the welfare implications. So this is a map of mainland France broken down into its 311 commuting zones, where darker shades of blue indicates higher unemployment rate. So you have Paris up here that has a relatively high unemployment rate, the metro area, because all of the suburban areas in France that have high unemployment. The Versailles commuting zone is next to it and has one of the lowest unemployment rates in the country, about 5%. Marseille is this commuting zone down here that has one of the highest unemployment rate in the country, about 12%. And in fact, a lot of the South has pretty high unemployment. That's the decentralized equilibrium before the policy is implemented. Once you implement the quasi-optimal policy, you see that the dispersion in local unemployment rates drastically drops. The map is a lot more uniform in color. And why is that the case? Well, you're slapping a 30 percentage point corporate tax on top of whatever is going on in Versailles, relative to Marseille, where the corporate tax rate is 0%. So the gap is 30 percentage points. That's a really large difference in corporate tax rates. That makes the Versailles much less attractive for businesses. And so, businesses move out of Versailles. And these are the high quality employers. They're leaving Versailles and say they move into Paris, which is the next best location. Then the employers in Paris move to Lyon, and then the employers in Lyon move into Marseille at the margin, Marseille is attracting more productive employers. And so that leads to a drop in the local job losing rate that is quite substantial, about 5 percentage points according to the mall. Now, of course, in Versailles, they're losing jobs. So the job finding rate declines and the unemployment rate goes up by 1 percentage point. But overall, this vast relocation of jobs across France leads to a 5-fold reduction in local unemployment rates. Also, it leads to some more modest reduction in the aggregate unemployment rate. Okay, now that was sorry, I should have said this is the quasi-optimum policy. Remember, it's kind of a really large policy. The enterprise zone program is going to have very similar allocative effects, but just muted because it's a smaller policy. Okay, and so let me now contrast the welfare gains in the quasi-optimal policy, that's the left panel, to the welfare gains in the enterprise zone program, which is the right panel. So we have on the x-axis, we have the local unemployment rate of every location in percentage points in the decentralized equilibrium before the policy. And the bins are not equally spaced because I've grouped all the cities in equally sized population bins so that you can kind of integrate visually, if you like. On the y-axis, we have welfare gains and consumption equivalent percent. Okay, so what's happening? Well, in the quasi-optimum policy, following what we've seen for the allocative effects, you're putting a big tax in Versailles. So, jobs are leaving Versailles, so you get a welfare loss there, but they're moving into places like Marseille, which would be around here in this picture, where this inflow of more productive, more stable jobs is beneficial for the local economy and raises welfare by about 10%. Now, if you contrast that with the enterprise zone program, of course, the gains there are much smaller. First of all, the set of treated locations was a lot smaller. That's the gray area. And the gains are concentrated there and are much more modest in magnitude, about 3-4% on average. Now, the interesting question is, well, what fraction of those gains is coming from the direct impact of the policy versus long-run human capital accumulation gains? And you can run that decomposition inside the model. And it turns out that most of the welfare gains from these place-based policies are coming from long-run human capital accumulation gains, and reduction in scoring effects in these locations. And so in cities like Marseille, about 80%, 90% of the welfare gains are in fact coming from these reduction in scoring effects. So now workers are employed more of the time. They don't go through unemployment that often. That's good because they earn more just because they're employed more often. But importantly, that lets them accumulate valuable skills over their lifetime, leading to these large gains. And for the enterprise zone program, in relative terms, the picture is the same. Most of the gains are coming from human capital accumulation and reduction in scoring effects. If you aggregate those gains across France, the quasi-optimal policy raises welfare by 1%, and the enterprise zone program reduces it by a more modest 0.1%. But now, of course, if you adjust that by the amount spent or the amount of redistribution that you have to do to achieve your desired program, the enterprise zone program turns out to be about 5 to 6 times more efficient per dollar spent, and that's because the planner's objective is concave, and so you get the highest bang for the buck close to the decentralized equilibrium. And so that's just one useful statistic to keep in mind if you think that there are other frictions in the real world, and there presumably are, that kind of make these place-based policies difficult to implement. You can think that firms are going to try to shift profits across establishments. You can think of local political economy constraints that are going to add a deadweight cost to implementing those redistributive policies across space. Then a planner may want to stay closer to the scale of the enterprise zone program rather than going all the way to the quasi-optimal policy. And with that, I'm going to conclude. So this paper have argued that the geography of unemployment is driven by differences in the rate of job loss across cities. I've shown you that relationship in France and in the US. I've also shown you that in the data, employer heterogeneity is really key to understand differences in job loss. I've then proposed a view of spatial unemployment that emphasizes this employer heterogeneity. And along the way, we've seen that once you write down that theory, labor market frictions tend to distort the location decisions of these employers. And that has important implications for place-based policies. You want to relocate high quality jobs towards low income locations, which is kind of typically you get the opposite with standard agglomeration forces. And you can get sizable employment and welfare gains. And so that way you can rationalize actual policies that you see in practice. However, in practice, successfully implementing these place-based policies may be quite challenging. And I think there's a lot of interesting work in that direction. And with that, I'd like to thank you very much for your time and your attention.
Great. Thanks, Adrien. Great presentation. So I will ask a question which Jose also typed, but also let me give heads up that due to another hard commitment, I will have to drop in 10 minutes. Adrien is a co-host, so people are welcome to stay and discuss, but I apologize in advance. And also let me mention before that happens that in 2 weeks, we will meet again to listen to Alessandro's Forza. So with that, I was also curious about the AKM, about Kramer's Margolis type regression, Adrien, at the very beginning. Jose asked about that. That's a wage decomposition identified from switchers usually. Here you use it in a slightly different way. There's no covariance here, right? And then Jose, maybe you follow up and ask your question.
So so you can, I wish I had a board, but so it's really like AKM. Instead of putting wages on the left-hand side, you put job loss indicators. And then it, runs exactly the same way. It's identified from switchers. You're absolutely right. And then when you do the decomposition, you can do it, you have two pieces, and so the variance of the sum of two things is variance of the one, variance of the second, plus a covariance term. You're absolutely right. That's one way of showing the variance decomposition. The other way is simply to say variance of the left is equal to covariance of the left with the first term and covariance of the left with the second component on the right hand side. So that's kind of splitting the covariance equally between the first piece and the second piece. It's a little bit easier to show. Now, what you can see from here is that once you aggregate at the local level, the two pieces are strongly correlated. They both go in the same direction.
Okay.
The worker and the employer component go in the same direction. Yeah.
Got it. I won't take time. I'll follow up with you later, but there is a good critique of AKM methodology in regard to the ones that are actually stable are the ones that are more sort of positively, like it's related to Alessandro's question of you bring in later in theory worker heterogeneity, but in reality, in the empirics, the fact that there's potentially a positive assortative matching between workers and firms leads to some issues with the standard AKM, and there's a way to correct for it. But anyway, Jose.
Well, positive assortative matching per se is fine. The problem is if switches are correlated, your worker type, you're absolutely right. If your worker type improves when you switch to a better firm or a better location, then that's a problem for AKM. Now, this is kind of in the absence of some experiment that randomizes people, which is always hard to come by. This is kind of the best you can do. So it's going to capture, some sort of long run effect. So that's one issue. The other challenge is, of course, all the econometric difficulties with like limited mobility bias. And so there's different approaches to do that. You can do correlated random effect. You can do clustering. So these results are for clustering, and you can vary the number of clusters, and the results don't change too much. But I agree with you that you're always relying on this assumption of conditional random mobility once you're in the AKM world. Point well taken. Alessandro, you were asking earlier whether so let's make sure I understand your question correctly. You were asking whether the beta J here that I'm getting from this regression is actually correlated with the beta tilde J I would get from doing a similar AKM regression with wages. Is that what you were asking?
I think it was Jose. No?
Oh, Jose. Oh, sorry.
That was my question.
Sorry. Yeah. Remember the question. Sorry, Jose.
I think that was the specific question. And what I was having in mind is whether, for example, your model could somehow replicate these facts, this correlation, and that would be a non-targeted moment that would be very interesting.
I see.
And in terms of welfare, it would be interesting to see, for example, if we want firms that are high-wage fixed effect firms, and this is very positively correlated with the heterogeneity in this dimension of the unemployment, then the welfare might be magnified by the place-based policies that you have in mind.
Correct.
If the correlation is very negative, then it's less clear how to think about it, because you might correct one in detriment of the other one.
Yeah. No, that's a great point. So the short answer is I haven't tried that. The correlation between the firm effect for wages and the firm effect for separations. My guess, though, is that they're going to be highly correlated. Why? Because of this graph. This is unconditional on worker composition, but worker composition, there's always positive. There's usually positive sorting, so it's going to kind of mute the slope a little bit, but it's not going to change the downward sloping relationship that job loss is going to be decreasing in labor productivity, and labor productivity feeds into higher wages. So my suspicion is that they're highly correlated, which is hopefully a good news for the mall, because in the mall, the firm premium is 1-for-1 with the separation probability. And so it's all a function of the idiosyncratic productivity Y. Where is it? This guy, your draw of Y0, so that you get initially and then it slowly depreciates. And so that's gonna, if your Y0 is very high, you have low job loss probability and high wages.
So actually, yes, part of my comment was exactly about this, because your model has a very strong prediction about this correlation. Yeah. And
I mean,
who knows models, what that is?
All these labor market models tend to have a really strong prediction that these things should be 1-for-1. I mean, then you can throw in some exogenous job destruction, and that's going to mute the correlation as well. And so you're right, it would be a nice over-identification check to see whether the AKM premium from separations indeed correlates with the 1-for-1. That's something that can be looked at for sure. And so kind of that amplification force that you were talking about, it's kind of already in the model.
So the actual policy that you had a quasi-optimal, and then I forgot the French term, but the small place-based policy, since that is affecting the data generating process in the quantification, do you incorporate it?
That's a great point. So no, I don't. Just because it's very hard to come by kind of location by location measures of effective corporate taxes, and in particular how they're affected by the policy. So it's not, that's why it's a budget equivalent version in the mall. So it's a stylized version of that policy. The good thing in some sense is that all the effect of the policy is really small on the, and so it's unlikely to affect a lot the estimation. The taxes are mostly going to affect the estimates of local productivity that I recover from the data. But in some sense, whether they're wrong by 0.1 or 0.001%, and then you add, you kind of replicate the policy on top of it, you're not going to be making big mistakes. But that's, because the program is small to begin with. If it was bigger, it would be much more of a concern. I agree with you.
I have two curiosity. I don't know are we free to ask now, or yeah, okay. So I just have two curiosity. I just missed it. So this policy, the real policy, let's say the EZ policy, economic zone or whatever it is, is it already implemented? That's the first question.
Yeah.
And so you see firms opening up in different locations, in these locations, so you can show that?
So there's been some different diff type evaluations of the program, and you do see that firms respond. So that should have been another part of my answer to your question about location decisions, is that we do see firms reacting to these tax incentives, and they do open shop in the treated places.
It's not just big enough, I guess. It's not.
I mean, of course, you have to scale by the size of the program, so you don't see massive effects on the commuting zone because the program is still pretty small. But you do see firms responding, and interesting. The main margin along which you see them respond is job creation. They do create jobs in these places, so that kind of lines up with the structure of the theory.
Yeah, and your policy instead, I just missed that, just for me to have the clear picture of what you're showing, is increasing by 30%, for instance, the cost of capital, whatever it is, I don't remember, the tax rate.
There's a corporate tax credit. Yeah, exactly. So you get
on top of what it is already the tax rate. So there is an actual tax corporate rate, which is like around 15%, and you increase it to 45%.
Exactly, in Versailles, exactly.
Okay.
I mean, the national corporate tax rate that gets just loaded in mean productivity because it's invariant. It's not changing in any of the contractual. Yeah.
So I'm not wondering whether it's correct. I'm just
no, that's how it works, exactly. So and then Marseille gets if you start from 15, Versailles goes to 45, and then Marseille goes to whatever, something. Well, it stays at 15 if you start at 15, you can say Versailles goes to 30, and then Marseille goes to 0. It's just the differential that matters.
And sorry, I have another one. Sorry.
Sure, go ahead. Yeah,
I'm very curious and very, and so can you make it dynamic? Like, so okay, let me try to rephrase. So this is kind of a long run, like,
yes,
like, so it's static, but long run. So you can see what happens in whatever, in the long run, let's say. So under the assumption that, so it would be, I think it would be cool to see in a model with all this, sorry, Jose, if I'm talking too much, sorry, maybe it's annoying for other people, but so in a model in which, all these agglomerate, like, there is this Marshallian kind of agglomeration force, and then there are all these other friction. It would be cool to see, I was thinking, it would be cool to see, a firm reacts to the incentive and sorts into a local labor market because it responds to incentive. And then suppose that every period you kind of have, think about this as a migration share, that you sort across location depending on the odds ratio, whatever, and there is a friction, there is an exogenous shock that, you draw it from a whatever productivity. And then basically firms in that sense, they can reoptimize dynamically to the environment. Then you can actually show in a super cool way, I think, also this agglomeration, like the size of these agglomeration forces, how they pile up, no? That would be super cool.
I completely agree. So I have
another paper, not in this one,
Yeah. No, I initially, did something like that. I mean, in general, equilibrium is hard, but if you just, change one location, you can do it. If you shock one location.
Yeah.
The one, so I've done it, and it's like I say, and it's kind of interesting. The one thing that for me is a little creates attention when you think about transitional dynamics is that this model doesn't have job-to-job search, and that's an important margin of reallocation along the transition. And so once you're bringing a new firm to a new place, it's like, much better say, I don't know, Boeing opens a factory somewhere. That's a much better deal for most of the firms, the workers in the local labor market. So what you would see is that they're going to quit their job, go through unemployment, and then go to Boeing. So that creates just a lot of reallocation through unemployment, which to me doesn't sound very realistic. I think in practice, people's kind of, search on the job. And so you would have to first enrich this with on the job search to really think about those transitional dynamics. But yeah,
because you have this period of unemployment from one job to the other, kind of.
Yeah,
you need
really
to have
it.
To, you need to have it to understand, to solve. Yeah.
And so for these reallocative, for the transitions and the reallocative effects, I think you need a model with a job-to-job search. But there, you could simplify this model in many ways, and then do it with job-to-job search.
Yeah, sorry, I'm thinking.
Yeah. No, it's a great point, and I was super interested in that initially, and so but when you try to look at what it does, you get these strange reallocation effects, which feel a little odd, and so it's kind of screaming for the missing piece of the model. For the long run, it doesn't matter, but for the short run, it does.
It matters for the transition of the
exactly
dynamics of the transition, that you want to observe from period to period. Then it matters a lot when you have this friction in between but it's cool because it's like, I mean, it's cool. But it's nice because it's like, it speaks also a little bit to the urban economic kind of literature in a way, that you can
exactly
you can start thinking about this as a tool, as a toolkit that you can enrich to think about urban questions.
Exactly. So initially in the paper, I did have some sort of $1 million plant experiment. It was all long run, but I was looking at that precisely. Suppose kind of you add a high Z firm in an otherwise low Z labor market, and then you look at the impacts on. And it's interesting. This model does not have any agglomeration economies. I mean, in productivity, it's all exogenous. I mean, there's the human capital, of course. But then there's the human capital. There's the sorting, and if you run a $1 million plant experiment in this model, you get almost the numbers that Grinson, Hornbit, and already get spot on. I mean, you get like 2% productivity gains, measured productivity gains, and other stuff. And that's all coming from the resorting of firms that you bring in $1 million plan. Well, that attracts other good firms to the location, and so they come in, and so that gives you an increase in measured productivity plus the human capital on top of that. So it's kind of interesting. You don't need agglomeration, in productivity to get the same effects as the $1 million plan paper.
I mean, you have a number of equivalent mechanisms, no?
Yeah, exactly.
So,
but in that paper, it's very much interpreted as, productivity goes up because there's some knowledge sharing, which, I think is very plausible.
And also in your model, you're just not modeling it.
Exactly.
In your model, there is this accumulation of knowledge through the fact that they are not
exactly. So it's going through that. Exactly. Yeah. It's going through that part. Exactly.
I was thinking sorry, maybe we're bothering everybody. And then I let you go, sorry, but I'm very excited about this stuff nowadays. And
I'm happy you're
I was thinking that maybe it would be because when you started thinking about this, I saw this presentation I think a year ago, a different conference, but I was, not thinking about this topic back then, and now I am. And so when you started talking, I thought about the $1 million plan experiment, and then I thought about the dartboard approach experiment. That's why I asked you
Oh, sorry, which one? What was the second?
The dartboard approach, like the Alisol and Glaser kind of thing about throwing firms randomly in a geography and see what, happens then. As a counterfactual, as a counterfactual economy.
Yeah.
Suppose firms strategically sort in a specific place because there are reasons to sort in a specific place. That's going to generate a number of dynamics, a number of outcomes. Suppose I want to do a counter experiment in which I randomly allocate firms a number of times in this geography.
Yeah.
How bad am I going to do?
Yeah.
Oh,
that's that's interesting. In terms of allocations, the closest I have, it's not quite what you're asking for.
That's when I thought about that,
The planner allocation has a much more uniform distribution of firms across space, and you're not going to match the unemployment rates. Now, of course, it's actually going to be better for welfare to have the more random allocation because the planner wants a more uniform allocation. Now,
sure.
That's almost correct, what I said. It's not entirely, let me show you that's the kind of the cross-sectional allocations.
Mm-hmm.
So the red line is decentralized equilibrium, the blue is the planner. So you see kind of the left-hand side is the y-axis is job losing rate. So it becomes flatter. So that's what's going on. So it's kind of the assignment is more uniform. Now, there's a hiccup though. This is all a model where it's one-to-one assignment between Z and place. If you start putting different Z's in different places, then you get the pooling externality becomes a really big problem because then you get all this within labor market misallocation. And so it's kind of interesting, that if you do the random approach, then you're going to hit big time those pooling externalities. They're going to be really bad. Whereas if you do an assignment where it's almost uniform, but not quite. It's one-to-one, but it results in something that's almost uniform, but not quite. You're going to do better, and that's what the planner does here.
Mm-hmm.
This comparison starts to rely really heavily on the pooling externality. What I like about this environment is that because there's one-to-one assignment, even in the decentralized equilibrium, the requirement, the random matching really means that, if I'm a worker, I don't really know whether Google or Facebook is more productive. But I can't know whether Google is more productive than the local hardware shop. That's fine because they're never in the same market. And even off equilibrium, it's kind of small deviations. Whereas once you start comparing to this world where you're really randomly putting firms across places, then you're putting Google and the hardware store in the same location. And to make the argument I just made, you need to assume that workers can't really distinguish between them. And I think that's a little bit of a stretch.
Yeah, no, I agree. I was just curious to see.
Yeah. No, it would be interesting. You're right. That's a good point. I could maybe try.
Also, because not even this quasi-optimal equilibrium matches the facts that you were saying at the beginning about the previous literature that everybody was convinced that it was about creating new jobs.
Yeah.
About job losses. So not even that quasi-optimal allocation matches that fact. Which was, when I started working on people fired and I presented stuff, and then people started telling me, no, but that's not a determinant, you know. The determinant is the hiring rate.
Yeah, it's not.
Not in the data. I don't know. Like.
Yeah. I mean, it's interesting. I mean, you know, you can look across other margins like skills or industries. In the cross section, it's always job loss. That's kind of it's only in the business cycle that it's job funding. Now, there are two interpretations of that, in my opinion. The first one is, well, it's different mechanisms. And there's some nice work by some subsequent work that if you add job to job search to this type of model, then you can kind of get the business cycle versus the cross section right. The job to job search helps you there. But that's one. The other, to me, there's more of a measurement difficulty for interpreting those numbers, and that, you know, if you look at stuff across places or skills, the inflow outflow decomposition is exact because it's long run stuff. When you look at that decomposition over the business cycle, I mean, there's actually a kind of, you know, this whole debate that I didn't mention in the introduction, which is that what are we really measuring when we look at contemporaneous correlations between job finding rates, unemployment rates, and job losing rates? Because, you know, if you get a little bit of separations today, it's going to increase the stock of unemployed workers tomorrow. That's going to congest the matching function. And so the job finding rate is low for several periods. And there's this nice Fujita Rami paper that, you know, argues that if you do more of a dynamic decomposition, where it's a little bit like in a VAR, where you try to attribute you know, future high unemployment to past separation shocks, you get a, you know, decomposition that looks a lot like the cross section. And so, I mean, of course, you know, I think more work is needed to make that really an established, you know, conclusive stuff. But I think it points to a really neat idea that, you know, there's a measurement challenge in the business cycle part. It's not a measurement challenge; it's an interpretation challenge. And so, yeah, I think maybe the business cycle stuff is going to be revisited. Like the conventional wisdom is going to be revisited.
I agree. Yeah.
Anyway, it was super nice chatting with you, Alessandro. I'm really looking forward to your talk in 2 weeks.
It's going to be very empirical, but it's going to, you're going to see it's an older paper, but very cool stuff. I like this paper a lot.
Well, thanks a lot. I'm very glad you liked it.
See you in a couple of weeks.
Yeah, see you. Bye-bye.
Bye.
All right, and then unless anyone has more questions, I'm gonna shut down the Zoom. All right, thank you, everyone.